Section 7C has been a hot topic for tax practitioners since it was introduced into the Income Tax Act as part of the 2016 amendments. Now, it's one of those few sections that as soon as you mention the section number, most people would know what you are talking about. Now, SARS issued the draft interpretation note for comment on this provision late in November last year, and it's already closed for comment. Now, although it's only in a draft format, we can get some insight into SARS's thinking approach or how they interpret this provision. So you're listening to the Tax Break podcast, the podcast for South African tax professionals and tax practitioners. And today we are looking at some of the aspects that SARS address in this draft interpretation note. As always, before we start, I would like to ask you to rate the podcast on your favorite podcast platform. And if it's something that you want to listen to every week, please go and subscribe to the podcast. If you think that some of your friends and colleagues might also like it, I would like to invite you to send the link to the podcast to them. And then just a reminder, if you want to correspond with me, whether it's questions, ideas, or if you need some tax advice, my email address is in the notes to the episode. Right, so let's talk about Section 7C, and I would like to start off by just talking about what it is in a nutshell. And I think we can't really talk about the provision without looking at why it was introduced. So if we think about estate planning, if an asset is owned by an individual, that asset would form part of the estate of the individual and would be subject to estate duty when the individual passes away. Whereas if the asset is owned by within another structure, something like a trust, for example, then the asset shouldn't form part of the estate of the individual when that person passes away. Now, the trick with estate duty is to be able to get the asset to the trust in a tax efficient manner. Now, the individual can donate the asset to the trust. Then you would have capital gains tax on the disposal of the asset. Plus, you would also have donations tax on the value that was donated to the trust, and that's normally a cost that's too high for many people to incur to move the asset into a trust. Now, the alternative to that is to sell the asset to the trust, so you still have the capital gains tax on the disposal, but because you retain a loan claim against the trust, you don't have the donations tax. And the benefit of selling the asset to the estate or to the trust without charging interest on the loan is that you've essentially frozen the value of the estate for estate duty purposes. Now, it's exactly this practice that Section 7C was introduced to curb. So what Section 7C now says is that if there's a loan from an individual to a trust, then and that loan does not pay interest at the official rate, the difference between what the interest at the official rate would have been less the interest that you are actually charging on this loan is deemed on an annual basis to be a donation by the individual, and that donation would of course then be subject to donations tax. Now, if we look at the scope of Section 7C, it doesn't only apply to loans from the individual to the trust. It also applies to loans made to companies where the shares of those companies are owned by the trust. So in other words, it's basically the trust and all the companies that above a certain threshold where the trust owns the shares of those companies. It's also important that on the lender side, the individual side, that it's not only a loan by the individual, but it's also a loan by a company that's a connected person to the individual at the instance of that natural person to the trust or the company that sits below the trust. And then maybe I think the last aspect that is sort of, in my mind, part of the core of what Section 7C is all about is that one of the ways in which taxpayers then structured their affairs to not fall within the bounds of Section 7C was to fund the company that's owned by the trust using preference shares instead of a loan. And Section 7C has been amended subsequently to also deem those preference shares to be loans for purposes of Section 7C. Okay, so I think that's in a nutshell the key aspects of Section 7C. Then I would like to move on to point out a few things that we can gather from the draft interpretation note. So I've identified 4 things. The first one is that SARS indicates that the interest that you need to calculate, so in other words, what the interest at the official rate would have been, that is simple interest on the balance of the loan. So there's no compounding or anything like that. The calculation is simply the balance of the loan multiplied by the interest rate. The second aspect that they point out is that the focus of Section 7C is on the lender. Now, remember, Section 7C deems a donation to have been made, and residents are subject to donations tax. So if the lender is a resident, this individual making the loan, or at whose instance the loan has been made, then Section 7C comes into play. What's also important about if we look at the cross-border side, so if the lender is a resident, irrespective of whether the borrower is a resident or not, 7C is something that you need to consider. Now, in a cross-border context, there was an amendment recently to make it clear that even if you've made a transfer pricing adjustment up to what the arm's length interest would have been, if this arm's length interest is something less than the official rate, Section 7C would still apply to the difference between that arm's length interest and the official rate. So you would have a top-up tax, even though you are the interest has been adjusted to the official or to the arm's length rate. You could still have a 7C effect if that arm's length rate is less than the official rate. The third aspect that I would like to highlight, and that's now specifically to do with loans made by companies connected to natural persons, where the loan is made at the instance of the natural person. So then there would be a donations tax effect for the natural person at whose instance the loan has been advanced. Now, SARS provides some of their interpretation as to what it means for a loan to be advanced at the instance of a person. So they're saying that if the person suggested or instigated the loan, then they are of the view that it was done at the loan was made at the instance of this person. Now, there could be some scenarios where if you look at the detailed wording of Section 7C, you've got parallel trust structures, so two trusts with companies below them, and these companies lend money to each other. And I think there are some scenarios, especially if the natural person is the only director of the lender company, where I think there could be an argument that Section 7C, that scenario falls into the wording of Section 7C. Although it's value being shifted between trusts essentially, not from the individual to the trust. Now, interesting is that SARS mentions in the draft interpretation note that underlying to this concept of loans being advanced at the instance of a natural person is that this should result in a wealth transfer from the person to the trust. So there might be something in the case of these parallel trust structures that there could be something in this that could help you to formulate a view that Section 7C should perhaps not apply there, seeing that there is no wealth transfer from the person to the trust. However, one has to keep in mind that you still need to work with the actual wording of the legislation. The fourth point that I would like to point out, and the last one for today, is that, and it specifically relates to a scenario, it's been something that's been contentious since the introduction of Section 7C, where a trustee makes a decision to vest an amount in a beneficiary of a trust, but instead of paying that amount to the beneficiary, the amount remains outstanding on a loan account. So in other words, we're back into the realms of Section 7C because we've got an amount owing by the trust to an individual. Now, Section 7C, one of the requirements is that the individual must have granted or advanced or provided the loan to the trust or the entity under the trust. So what SARS indicates in the draft interpretation note is that the word to, or the phrase to provide, implies a conscious decision rather than just mere acquiescence to say, but it's something that happens and you have to accept it. So what I think we can take from this is that you need to look at the facts and circumstances very carefully to see, but was there a conscious decision by the beneficiary to make this money available to the trust? That could be an election by the beneficiary to keep the vested amount outstanding on loan account, a suggestion by the beneficiary to do it in this way, or agreement by the beneficiary in this way. If it's just the trustees telling the beneficiary this is how it's going to be, I think there's probably a good case then to be made that the loan was not provided by the beneficiary. Okay. What are the takeaways from this episode? One is the draft interpretation note gives us a bit of guidance on how to do the calculation of the interest. It also provides us with clarity as to where the focus of Section 7C is, being on the lender as the person who would be deemed to make this donation. It provides us with some insight into what it means for a loan to be made at the instance of the natural person, and then it also highlights some of the nuances that may arise in the context of trusts vesting amounts to beneficiaries on loan account. That's it for today's episode. Just a reminder, as always, nothing in this episode is intended to be tax advice or a replacement for tax advice. Until next time, goodbye.